Greetings and welcome to the ROIClear podcast. My name is Ray Hightower, and today we are fortunate to have as our guest Mr. Tyler Lyons. Tyler is Chief Investment Officer of ASYM Capital. We're going to dig into what that means with him today. He's a commercial real estate investor. He knows a lot about business, a lot about leadership, so we're going to explore all of those topics today. Tyler Lyons, welcome to the ROIClear podcast.
Thanks for having me, Ray. It's a pleasure to be here, and it's great to see you as always.
Yes, very glad to see you as well. And to kick things off, we'll start with an elevator pitch. And for those who are new to the ROIClear podcast, Tyler Lyons is on an elevator with someone he wants to influence. So Tyler, what would you say to that person in the course of an elevator ride?
So I'll try to keep this brief. It might get lengthy, but given that it's an elevator pitch here, I would say that so at ASYM Capital, we are a multifamily owner and operator, and we're hyper-focused on the Phoenix market. So the only thing that we look at in terms of commercial real estate, it's just multifamily, just in the Phoenix MSA. So as an owner and operator, that gives us a lot of benefits. You know, first of all, we know the market very well. We know all of the submarkets. We know the market on a street-by-street basis. We know it exceptionally well. We know where the puck is going, you know, in terms of where the development is coming, where the path of progress is. We're a hyper-focused multifamily investor, and we look at just the Phoenix multifamily market.
Just the Phoenix multifamily market. We happen to be in Phoenix right now. We're in the Phoenix MSA right now. Just Phoenix and just multifamily.
That's correct.
So you have a tightly focused niche.
We do.
And what's really interesting about that is I think about something that Charlie Munger used to say a long time ago. He just passed away very recently, but Charlie Munger used to say that if you want to achieve business excellence, you want to have a focus that is small and tightly defined, not big and fuzzy.
Mm-hmm.
Tell us about the process that you went through to begin focusing on that small and tightly defined niche. How did you choose that particular niche?
Yeah, that's a great question. And I can give you some background in ASYM Capital too, because it was a bit of an evolution to get where we are today.
Yes.
So historically, ASYM Capital used to be more of an equity raising company, equity placement agent. We would partner with sponsors on different deals across the nation, in different markets and different real estate asset types, and we'd partner with them by raising capital and bringing money into the deal.
Mm-hmm.
So when we used to do that, we had much more of a diversified sort of approach where we would partner with different sponsors, again, kind of across the nation, different asset types. And it's kind of cool because it gave us the opportunity to bring many different investment opportunities that were pretty unique to our investors. But eventually, as we kind of grew up as a firm and we started to build out the team and mature as an organization, you know, we looked at it and we kind of decided, hey, you know what, we can raise quite a bit of money. You know, as we stand here today, we've raised something on the order of about $85 million, pretty much entirely from individual accredited investors. And we've had the pleasure of serving about 500 accredited investors during the firm's history as well. So eventually we looked at it and we said, hey, look, we can raise quite a bit of money. We've got good chops in the industry. We've got good connections. Let's kind of narrow our focus a little bit more and start raising money just for deals where we're the owner-operator or we have some sort of significant seat at the table. So we made that decision a little bit over 2 years ago. I've been with the firm for over 3 years now.
Mm-hmm.
And, you know, I kind of noticed pretty early on when I came to the firm that, you know, we can raise quite a bit of money. Like, why don't we kind of go out and start doing our own deals? And it's pretty interesting because I didn't really have to do a whole lot of convincing to my business partner, Hunter, who's the founder of the firm.
Yes.
He was kind of already thinking about that as well. And it was really just a matter of really thinking through, okay, this is the change that we want to make. So what's the best timing to do that? And where might we want to participate? And when we were talking about this would have been back, you know, probably late 2021-ish. And at that point in time, the multifamily industry was exceptionally hot, right? I mean, valuations got crazy, transaction volume got crazy.
Yes.
You know, people were selling these properties sometimes in 18 months for 2x equity multiples. Like the market just got really frothy, really hot, and really competitive.
Yes. Yeah.
So at that point in time, it really wasn't a good point for market entry. But then as we kind of stepped into 2022, you saw it, I saw it, the rest of the industry saw it.
Mm-hmm.
The Fed went on this rate hiking cycle that's one of the most aggressive that we've ever seen in history.
Sure.
And once that started to happen, the commercial real estate industry changed pretty much overnight.
Right.
So we went from a situation where had we wanted to make that strategic change, say back in 2021, it would have been difficult to even get on the phone with a broker, right? It's like, okay, you're this interloper, this new person from out of town who wants to just come into town and start buying apartment buildings now.
Right, right.
Like, who are you? Like, I'm going to go sell to
Yes.
these guys I've been working with.
Yes.
So when the market changed like that, we looked at each other and we're like, wow, like if this is the best opportunity to make the strategic shift. So we made that strategic shift at that point in time, and we started focusing on the Phoenix multifamily market, which I'm happy to dive deeper on the reasons therefore, if that'd be helpful.
Oh, we are going to dive deeper into that, absolutely. So to just summarize what you just said, you went from a period of time where when you'd approach brokers, 2020, 2021, you'd approach a broker about doing deals in Phoenix and they'd say, go away, son, you're bothering me, to now where you've got a track record. You personally have a track record. Hunter certainly has a track record as well. And collectively, you have a track record where you have credibility. You've raised over $85 million for deals for other people as well as your own deals. So you've got the track record and you've got the excellence that's established there and the credibility there. So it's been great watching you do that. I'm fans of I am a fan of the work that you do, certainly.
Appreciate
now, you beat me to the punch a little bit because I was going to ask you why the Phoenix market? Because, I got to tell you, you're right. You and I both saw people doing deals in this market where they'd go in and come out with a 2x equity multiple in less than 2 years. I'm thinking of one in particular where they did a 2x equity multiple in 23 months. And that's incredible. I don't know if we'll ever see anything like that again. So the question is this. If people were able to achieve that then, has all the juice been squeezed out of the orange, or are there still some more squeezes left? And how do you go after that? So, tell us about that.
Yeah, it's a really interesting question. And seeing deals like that go 2x equity multiple in a 23-month period, I don't know if we'll ever see that again. I hope we don't see that again, actually. I mean, you and I were owners and operators in the multifamily space, so you might think to yourself, wouldn't you want to see that? But the thing is when the market behaves like that, and a lot of that was because of, kind of just external factors that were at play. When the market behaves like that, things get so out of whack that it really becomes difficult to have predictable outcomes.
Right.
And when you're a multifamily investor, like I'm all about predictability of outcomes. That's what I'm looking for with a deal. I'm not looking to get rich quick. I'm looking for a long-term sustainable business plan where we can create cash yield and alpha for investors over a long period of time.
Right.
So that's what we're looking for. And in terms of whether or not there's any kind of juice left in the orange, it's a great question. And I think it's a really interesting time in the market cycle right now, because when we got to the peak of the market, say late 2021, early to mid 2022, we saw valuations get really, really high in the multifamily space. You'd pick up a broker offering memorandum, and it's like pretty much everything was a 3 cap rate, right? It's like Class A is a 3 cap, Class C is a 3 cap. Everything compressed down to a 3 cap because the market got so frothy. There's so much capital flows coming in.
Sure.
And when you've got demand for an investment type and you get capital flows coming in, that compresses the cap rate and increases the valuation. So you saw valuations get sky high. Now, what we've also seen is now that the Fed has gone on this rate hiking cycle, which is recently reversed, thank God. I think we can all be pretty happy about that.
Yeah, 50 bips,
Absolutely.
Let's get 50 more bips.
Yeah, I think we'll see it too. So now that is reversed, but because interest rates ran up so much, that had an adverse impact on valuations of multifamily. So where we stand here today, Ray, I mean, valuations are probably 30 to 40% off of the peak of where we would have been at peak pricing back in 2021 and 2022.
Yes.
So now we sit here and we're in a premium multifamily market, which we can talk about the reasons why for sure if you'd like to.
Yeah.
But we're in a premium multifamily market and we're seeing opportunities to buy multifamily real estate for discounts that are 30 to 40% compared to where we were just 2 years ago.
Yes.
So the value add space is a little bit tougher right now for sure. Kind of tough to make deals work there, and you're not seeing many deals there right now. But there's some distress in this market right now too, which also creates opportunities.
Right.
So I think there are opportunities. The distress isn't quite what I thought it might be, because in that run up when valuations went really high, We saw a lot of deals that were purchased with really aggressive bridge debt financing.
Mm.
Well, those 3-year terms oftentimes are up now. So
Mm-hmm.
people are kind of kicking the can down the road and figuring that out.
Right.
So you've got some debt-related distress. Most of it is debt-related distress. And you've seen some deals come to market that actually were REOs, not many of them, but a
Right.
handful.
Yes.
But you're seeing a bit more, I'd call it kind of like the quiet distress, where people are
quiet. What is
yeah.
quiet distress?
Yeah, so I'd classify quiet distress as folks who are coming to the market and selling a deal,
Mm-hmm.
and it might not necessarily be touted or marketed as a distressed opportunity.
Mm-hmm.
But when you peel back the onion and start looking at the deal and start doing due diligence on it, you start to see pretty quickly that this is a distressed opportunity.
Mm-hmm.
And oftentimes the quiet distress, it's more of the financial distress sort of situation where
Yeah.
they've got a floating rate bridge loan. Like, for example, we were just looking at a deal a couple of weeks ago that we made an offer on. And, you know, you looked at the operating statements and everything looked pretty awesome.
Mm.
And then you kind of like got in a little bit deeper and it's like, oh, wow, this is floating rate CMBS debt. They're below 1x debt service coverage ratio. They are probably going to take a haircut when they sell. So on the surface, everything looked pretty good, but you start peeling the layers back a little bit. It's like, okay, like you kind of have to like dig to find out, but this is kind of a distressed opportunity. It's not like a house fire, crazy sort of a distressed opportunity, but there's a lot of motivation for this particular owner to
Sure.
sell and get out of this deal. So that's kind
Right.
of what I meant by more of the quiet distress.
Right, right. So the bottom line is you had to dig deeper. You couldn't just look at the trailing 12, the profit and loss statement for the previous 12 months. You couldn't just look at that. You couldn't just look at a rent roll and put those together and come up with a pro forma, the way everyone learns in their multifamily class. You had to dig deeper. You had to look at the loan documents and see, maybe they had a 1.25 or better debt service coverage ratio when they went into the deal. But today, because they had a bridge loan and the interest rate had gone up, they were actually flipped. Their DSCR was now below 1.0, which is not anywhere you want to be. Banks want to see you at 1.25 or above. As investors, we want to be higher than that.
Yeah.
And if you're upside down, then you're paying the bank for the privilege of owning real estate, which I think is not the way a good capitalist operates.
Correct.
Correct me if I'm wrong.
That's
I think we
spot
want to
on.
make money on that, right?
Yeah, that's spot on.
Okay. All right. You've said so much here, and I could go down bullets. I love the way your brain thinks because you're going through everything that you're doing here. Opportunities in the Phoenix market, all
Yeah.
of the influx of people moving to Phoenix, people moving to Arizona. How much of that is due to good things about Arizona versus people leaving California or whatever? What do you think is the big driver? Because we have people coming to Arizona every day and they need a place to live. You know, some are attracted to cotton, cattle, copper, and climate, you know, the 4 C's that they say
Yeah.
for Arizona. Some people are attracted to that. Some people are just leaving a bad tax climate in California. Which do you think is the bigger factor? And tell us a little bit about that, please.
That's another really good question, Ray. And I would say it's kind of hard to parse kind of like on a percentage basis, like how much is it just really Arizona being an amazing place to be versus,
Right.
you know, places like California. Obviously, population is decreasing in California, and we're getting a lot of people coming from California to Arizona.
Right.
Because, you know, for politics are getting a little bit crazy there. People
Yeah.
who value freedom, that sort
Right.
of thing, they might
Right.
want to come to a place like Arizona. So Arizona's been a huge beneficiary for both reasons, people leaving other places that are becoming less desirable, and also Arizona being just a cool place to be at the same time. You know, I think a big thing that drives a lot of people to Arizona is jobs. You know, and one of my early mentors in the business, I asked him like, hey, look, what do you look for in a multifamily market? You know, a very experienced guy with decades of experience. And I was expecting some sort of really long, detailed like thesis on like what he looks for,
With
you know.
Greek letters and a long formula or something. Yeah. Okay.
Exactly.
Yes. Yeah.
And basically he's just like jobs.
Yes.
You know, it's pretty much how he responded.
Yes.
So that's definitely a big part of it, right? Arizona is a very business friendly sort of place. So we've got massive corporations making huge investments in Arizona over the course of, you know, many years now too.
Right.
It's kind of interesting to observe in 2008, you know, when the global financial crisis came through, the Phoenix area and Arizona got absolutely crushed, right? Because back then, the economy in Arizona and in Phoenix was so dependent on construction and housing
Yes.
that if you have a subprime mortgage crisis and the housing market goes under, everybody just got nailed by it. And Phoenix was one of the slowest economies to build back after the global financial crisis. But here we sit now in 2024, and we just had another crisis, right? We had the COVID-19 pandemic and everything shut down.
Right.
And in the wake of the COVID-19 pandemic, Phoenix is one of the fastest markets to recover. And the reason for that is because in that 15-year, 14-year period between the GFC and the COVID-19 pandemic, Arizona was really smart. I mean, you got to give the governor and leadership of Arizona a lot of credit because they did a lot to try to attract companies and investments into the state of Arizona. So now we sit here and Arizona is a much more diversified economy. You know, you still have like real estate, obviously is huge, but you've got advanced manufacturing and just finance and many other business vertical markets that have really sprouted here in Phoenix and made it a much stronger market. So it's been really remarkable to see, but I think that's a big part of it is Arizona's a great place to live. You know, you've got freedom. The weather's great most of the time. I just survived my first summer here, so it's kind of brutal in the summer, but you know, it's great weather, plenty of jobs, cool place to be. And then, on the other side, you've got other places that have kind of lost their mind a little bit, and people are leaving, and Arizona's been a beneficiary. So I think both have been huge factors in the growth we've seen in Arizona.
Jobs.
It's very important.
And TSMC doesn't hurt at all. Intel doesn't hurt at all. All the tech companies on Elliott Road in Mesa. That is so exciting just seeing the growth here. And, you know, I'm one of those. I moved here from California. I lived in California for a few years, looked at doing deals there. And I found myself doing road trips to Phoenix and woke up one day and said, hey, why am I doing road trips? Why don't I just move here? That was 4 years ago, man. And looks like you had a similar journey. You were somewhere else and decided that you wanted to be here.
I did. Yeah, I did. Yeah, so when we started to make this pivot into really focusing on Phoenix multifamily at ASYM Capital, I was living in Michigan at the time. I spent the first 40 years of my life in Michigan. I'm from Michigan. I still love the state. And I was on a plane multiple times per month in some instances coming down here and, you know, looking at deals and touring deals and trying to buy deals. And, you know, we did a couple of acquisitions back in 2023. There was just a lot that brought me to Phoenix. And, you know, my beautiful wife and I got married a little over a year ago. And in the lead up to our wedding, we were talking about it. You know, it's like, should we move to Phoenix? You know, it kind of seems like that's where the business is going. So over the course of several months, we continued to talk about it. And eventually, we made the big leap a little bit over a year ago and moved down here. And it's been a blessing so far. The first summer is a little bit tough, but like overall, it's a great place to live, and we've been super happy with it.
You know what? Once it's over 108 degrees, it all feels the same, though, right? Wouldn't you say?
Yeah.
It's wonderful.
Yes.
Let's dig back into the life of the younger Tyler Lyons, because we know everything about we're learning more about you as Chief Investment Officer of ASYM Capital now, but I want to dig back into what shaped you. When did you decide you wanted to go into real estate? When did you choose commercial real estate? When did you choose investment real estate? And take us along that path. Why don't you connect the dots for us?
Absolutely. So I started my career, I actually got a degree in accounting. I got my CPA right out of college, and I worked for about 5 or 6 years for a large public accounting firm. Eventually, I made the change from that, and I worked for a large publicly traded company, kind of worked my way up to a director of corporate finance for that particular company. So when I was in that particular job, I was aiming toward potentially being a public company CFO. Like I kind of thought that was my career journey. That was kind of what I was aiming at basically for the first 14 to 15 years of my career. And during that journey, it wasn't long after I got promoted to kind of the director of finance role, I had this good fact pattern. I was fortunate at the time where I was kind of maxing out the 401k and, you know, I was single at the time or at least not married yet and kept the expenses low, and I was maxing out the 401k, and I started to build up some cash savings, and I was thinking to myself, what do I do with this money? You know, should I go start a business? Should I go buy a business? Should I try some different alternative investments? My mind was going in a million different directions on what I should potentially do. So it kicked off a period of time in my life of exploration, reading books, diving into a ton of different podcasts, and just trying to figure out what it was that I wanted to do. So eventually I decided I was going to buy a duplex just about 5 miles down the road from my house in Grand Rapids, Michigan, where I lived at the time.
All right.
So I bought a duplex, and buying that first duplex, it was really like a light bulb moment. It was an aha moment for me because I bought it, and it was kind of a rough go on that first property too. The contractor was a pain in the butt, went way over budget on time and cost, like all the horror stories that you hear about trying to do some of these renovations.
Yes.
So I did that first deal, but after I completed the construction and rented it out and refinanced it, and then for the first time ever experienced just my real estate making money for me while I slept, I had this realization where it's like, I need to do that like 100 times more.
Yes.
You know? So
right.
So that was kind of where my mindset went next. And it also changed my mind as well around how I thought about investing. Because what we're taught in the US, what Wall Street teaches us, what corporate America teaches us, is to basically save up and accumulate this nest egg for some future dream of being able to retire, right? That's what we're taught.
Sure.
So buying that first investment real estate property, it changed my mindset around retirement and setting myself and my family up for the future from this accumulation method to creating streams of income method.
Right.
Where it's like, I want to get as many streams of cash flow as I can to cover my living expenses so then I can go do whatever the heck that I want.
Absolutely.
And through that process, I really fell in love with the real estate industry. You know, so I bought that first property. I started buying more properties. I'm learning about real estate. I'm going to conferences. I'm building my knowledge and my network. And all the while, I was kind of starting to fall out of love with the day job too. You know, so these things were kind of going on at the same time. And eventually I found the world of commercial real estate a few years later. You know, I'm buying duplexes and fourplexes and single family homes and doing all this stuff for quite a while before I even learned, wow, that 200 unit apartment building on the corner over there, that might be like a group of investors pooled together to own that. Like it took me a while to find that in my personal education journey. And then once I did, that was just yet another light bulb moment, right? So then I started investing passively. And once I started investing passively, it's like, you know what? With my background in accounting and finance and kind of my institutional background, I think I might be able to do this. Like this might be a different career path for me.
Sure.
So that kind of just further sent me on the path. And yeah, there were a few more kind of intermediate steps there, but eventually met up with you know, Hunter Thompson, who's now my business partner at ASYM Capital. Started working with him full time, and now I'm a partner at the firm and moved across the country. You know, it's kind of the world of real estate's taken me on somewhat of a crazy journey that it wouldn't have been on my bingo card back in like 2016 or something like that.
Right.
You know, I wouldn't have predicted that I'd be on the other side of the country buying apartment buildings back then. But it's been a huge blessing, and I'm having more fun professionally than I ever have in my life. So
whoa, that is a remarkable background. And I got to say, you and Hunter Thompson really partnered together well. You two have complementary skill sets. Just getting to know both of you over the past few years, it just works out really well. So you went to school, became a CPA, had aspirations of becoming a CFO of a large company, and while you were on that path, bought a duplex, and that was the light bulb moment for you. And you said, "Wow, this duplex, even though there are a lot of headaches, you had to deal with what do they call it? Tenants, toilets, and termites, or there's another T in there, whatever. But all of those things that you have to deal with if you're doing the property management yourself, you dealt with all of that. But even with those headaches, Tyler, there's another T. Even with those headaches, you decided that you wanted to multiply that duplex by 100.
Correct.
And you've gone far past that 100, as a matter of fact. We'll get into that. So you looked at that. You decided that that you would, dig into that even further and build multiple streams of income. Started to fall out of love with your W-2 job, with your day job. Met a bunch of investors. Met Hunter Thompson. You guys decided to partner together. Now you're running ASYM Capital. I love the name ASYM Capital, by the way. The whole idea of asymmetric returns, we're going to explore that as well. So many questions I got to ask you. So many questions to ask you, Tyler. So, and then, now you and Hunter are running ASYM Capital, and, Hunter's got the things going on with Race Masters. Certainly you're helping with Race Masters as well, and the other things that are going on there. That's a remarkable story. I love the way you connected the dots there.
Appreciate that.
Tell us about ASYM Capital and asymmetric returns. I love the name ASYM and how it ties to asymmetric returns. I'm not going to explain it because you've got a pitch of a way of explaining it that I love. So we'll let you go ahead and take that away.
Yeah, so ASYM Capital, as you said, it's short for asymmetric returns, right? So
Yes.
pretty much when the firm was founded, and this has been our ethos throughout the entirety of the firm's history, but when the firm was founded, Hunter basically was looking for ways to invest that weren't correlated to the typical risks of the stock market. Because back then, this would have been back, I think he started the firm around this is like 2010, 2011 timeframe. You know, he's told this story on podcasts before and has told it to me before too, where basically, you know, he was trying to build an investment portfolio and there were these random idiosyncratic risks that might happen on the other side of the globe. And all of a sudden it's impacting his investment portfolio here in the US.
Sure.
Right. And it just drove him nuts. So it kind of sent him on this path of exploring and looking and trying to find investment opportunities that didn't have those same type of correlations to the normal stock market. So that kind of sent him down the path of exploring alternative investments. And oftentimes these alternative investments do have risks and benefits that aren't correlated to the typical stock market sort of investments, right? So when he first started going in the business, he started buying mobile home parks. And this is back in the day when mobile home parks are a 10% cap rate. You know, this is before mobile home parks became
10 cap.
Yeah.
Whoa. Okay.
Yeah, 10 cap. So this is, again, like over a decade ago, 12, 13 years ago.
Yeah.
But if you're buying a mobile home park at a 10% cap rate, I feel pretty confident that not only obviously the valuation increase that you experienced during that period of time as the asset class became more institutionalized, but if you can buy solid commercial real estate and you've got that kind of unlevered cash yield, you're going to be pretty much impervious to any sort of these other market gyrations and factors that are going on, right? So that's kind of the basis of ASYM Capital. It's really looking for investments that provide asymmetric upside compared to the risk downside.
Right.
You know, said differently, we're really looking for just solid risk-adjusted returns.
Solid risk-adjusted returns. And that's what you want your investors to think about and know.
Yes.
So then let's explore your choice of niche in that. Like certainly you've decided you want to do multifamily. You were, or ASYM rather, before you joined ASYM, was doing mobile home parks. Are you still doing parks today, or you've
Just
multifamily?
multifamily.
Okay, so you've shifted to multifamily, and you've shifted to multifamily in the Phoenix MSA. And tell us more about that. Are you looking at Class A, B, C? I kind of know the answer, but I want to give you a chance to tell our audience about that. What are you looking at in terms of class or in terms of unit count or unit mix, that type of thing? What are some other things that what are the bullets in your buy box?
Yeah, absolutely. Lot to dive in there for sure. So let's kind of start with the switch, kind of the shift in the focus into multifamily. So when you look at multifamily, if you kind of step back and look at it from a macro perspective,
Yes.
we've seen throughout history, especially in the wake of the GFC, we just, as a nation, we stopped building as much as we need to.
Yeah.
You know, we've got population growth here that's still really strong. We've got in-migration. It's still a strong economic engine. We need more housing in the U.S., and we've been perpetually undersupplied for decades now. We need millions of housing units in the United States.
Sure.
So from a macro perspective, like the thesis is very strong from that standpoint. But then you kind of step back and look at multifamily from a few different other perspectives as well. It is from a debt financing perspective, you can get the most predictable, most attractive debt financing terms in the in the multifamily space compared to other real estate asset types.
Sure.
That's huge because when you look at people who get in trouble in a commercial real estate deal, oftentimes it's the debt piece that gets them in trouble. You know, they have a maturity that sneaks up on them. It's something with the debt that causes people to lose properties.
It's a bridge loan that went up. Yes, right.
Yeah.
Okay, yeah. Okay.
Absolutely.
Right.
So yeah, it's like the kind of the supply and demand side story. The debt financing story is super important.
Right.
I like to invest in real estate asset types that are institutionalized and that have a lot of demand, which might be a little bit counterintuitive to some people because oftentimes you hear people talk about, hey, look at my unique investment opportunity. There's like no competition over here, right? I got this thing, like it's such a good price because there's no competition.
Right.
And it's like, okay, that sounds great right now, but talk to me 5 years from now when you try to sell that property. Like if there's no competition, who's your buyer going to be?
Sure.
So when you look at multifamily, like the capital flows and the investor demand in multifamily is so important as well. So it might be tough to find acquisitions. I mean, it's been a year since we've bought a deal. Unfortunately, we're getting closer though. We're going to make it happen pretty soon here.
Oh, I know you will. You're looking at a lot.
Absolutely. But when you look at the demand side and the competition side, like competition isn't something that should scare you. I think it's something that should get you excited because when you go to exit, like your exit might be that much stronger because you have buyers, you have capital flows that want those assets.
Right.
That's so important. So for a lot of those reasons, that's kind of why we decided to really kind of dive into the multifamily space and really focus on it.
Yeah. Yeah.
And then from a Phoenix perspective too, just to kind of walk you through a little bit more of that thesis. I know we've talked about many of the reasons why Phoenix is awesome, but again, like the job side, really important. And then jobs basically begets population growth. If you've got corporations making investments and really kind of like setting up manufacturing and headquarters in certain places, it's going to attract people and population growth. And then if you've got this corporate growth and population growth, you get some wage growth in there. All of this creates a very ripe environment for consumer demand for multifamily housing. So now you've got an environment where you have a lot of people, and you've got a lot of people who need somewhere to live and somewhere to rent.
Sure.
Right. So when you look at kind of the demand side of the equation in somewhere like Phoenix, it's just such a strong fact pattern that's just not going to reverse anytime soon.
Yeah.
And then you look at the regulatory side of things as well. Phoenix is a very business-friendly environment. If you need to evict people, you can promptly and easily. And in some of these other municipalities that we stay away from, I mean, you might have people squatting in a unit for 2 years and you can't get them out of there. And look, you just can't run a business in that sort of environment, right? We want to provide clean, safe housing for people. But to do that, we need people to come in and pay.
Right.
So that's really important as well. And the last thing that I'd touch on that I think is really important for Phoenix and maybe a little bit more under the radar, because you could say to me, look, Tyler, I mean, okay, job growth, population growth, wage growth, landlord friendly. Well, it's the same way in Dallas. It's the same way in Tampa. Like you're not telling me anything interesting, right? There's a lot of other markets that have that.
Yeah.
But a couple of other really interesting factors about Phoenix that I think are very important that people just don't give Phoenix enough credit for are property taxes are low and they're capped out at a 5% increase every year.
Yes.
So compare that, and I'm not dogging on Texas. I love Texas. I've got passive investments in Texas.
Dog on Texas. No, don't dog on Texas. But yeah.
But yeah, I mean, we both
Texas friends. We're just having fun. We're just having fun. Get over it.
Right. But you compare that to somewhere like Texas, that has notoriously high property taxes, and it's this environment where you got to go and hire attorneys to argue your property taxes for every year because you just don't know how crazily high they might get remeasured.
Yeah, you don't know.
Right.
They hide the sales price.
Right.
For that reason. Yes. Right.
Yes.
Yeah. Right.
Great point.
Yeah.
So property taxes are low here, but also insurance is comparatively low relative to a lot of these other markets as well.
We don't have hurricanes or earthquakes. There it is.
Exactly.
Yes.
Exactly. We've got a lack of natural disasters. And when you're a multifamily investor, I touched on this earlier, but what I'm trying to create is predictability of outcome. And if two of the largest expenses in my P&L are low and more predictable than other markets, that's a really big deal and something that we obviously put a lot of weight on when we decided to come into Phoenix.
Yeah, and those are two of the biggest line items in the P&L too, taxes and insurance. So yeah, there you go right there.
And for those of you listening to who might think like, hey, look, I invest in Phoenix. I've seen huge increases in my insurance. Look, we've seen some increases too, for sure. But think about it this way. If your baseline per unit insurance expense is, pick a number, $450 per door in Phoenix, and let's say it increases 30% from there, that's going to hurt pretty bad.
Oh, yeah.
But not as bad as a market where the baseline is $1,200 per unit, and then you increase 30% from there. That's going to hurt even worse.
Sure.
It's more of a larger, more pronounced impact when your baseline is higher.
Yeah. Yes. Absolutely. It's just math.
Yes.
It's just math. There we go. There we go. Let's talk about competition, because you mentioned competition in the market. And here's one thing that I've studied with you and Hunter, watching what you're doing with ASYM Capital, and really with a lot of people in this market. We we tend to do this. And by this is what I mean. We tend to cooperate with people who appear to be competitors of ours. And some people from outside of our industry don't necessarily understand that. I come from the tech industry where we cooperate with our competitors all the time. In fact, one example I like to use is you think of the Apple Macintosh platform, and I ask people, do you know who the biggest creator of software for the Apple platform is? And I ask them, and they'll say, just guess. Who do you think is the biggest creator of software for the Apple Macintosh platform? And they'll think, oh, I don't know. They'll guess some, different vendors. And you know who it is? It's Microsoft. When you think of Microsoft Office, which is a big deal. Everybody in corporate America uses Microsoft Office. So that's an example of coopetition. Some, those guys, they have sued each other over the years, but even when they were in court fighting each other over one line item or another, they were also making money together because Microsoft Office ran on Apple Mac OS. I think they were calling it Mac OS 10, right? Or whatever they were calling it at the time. But that same form of, even in the tech industry, they call it coopetition, because let's just make up a word, right? Portmanteau or whatever it is we call it. So what is it, and I've seen some of this, but I'm interested in hearing what you think about this. I've seen some of this in watching you and Hunter, and I study you guys because clearly you're good at it. And what are some things that you're doing to foster competition between yourselves at ASYM Capital and some of the other companies that might appear to be your competitors, but you guys end up making money together? Tell us a little bit about that.
Yeah, and that's one of the things that I love about this industry too, Ray, is that it is a very cooperative sort of industry, especially when you compare it to other industries. When we broke into the Phoenix multifamily space and decided we were planting our flag here, this is what we're going to do, this is what we're going to focus on, we received some help from a large owner-operator in the market who made introductions for us to basically all the brokers that we needed to connect with, debt brokers, property managers, contractors, like basically opened up the Rolodex, said, hey, here's the people that you need to talk to. Send emails with warm introductions. So Zach Haptonstall from Rise 48. Thank you,
Shout
brother.
out to Zach.
I appreciate that.
His office isn't too far from here. We could throw a rock and hit his. We won't throw a rock at his office, but it's that close.
Right.
Yes.
So I think the industry, my experience in the industry has been, it is very cooperative like that. And it's awesome. It makes it fun. Like, I've got so many friends in this industry because we all are trying to lift each other up. It's a tough industry. It's not rocket science, but it's an industry that's a simple industry, but a very difficult industry because it is competitive, because there's these things that you have to do over and over and over and over again. And a lot of people don't want to commit to the just rote repetition of doing some of these things over and over and over again. So it's a tough industry, but I really like it because we lift each other up. We've got, great friendships and relationships in this industry. And, the way that we look at it too, there are a lot of different groups out there where maybe we're trying to do the same thing, but we have conversations with groups almost on a weekly basis, just really thinking critically about, are there ways that we can joint venture on deals?
Right.
I mean, maybe we have to go buy this older 70s vintage property by ourselves if we're just using our own database. But if we join forces, maybe we can go buy this bigger, nicer, newer Class A deal in a good part of town. Like, I would say like that's kind of that's a big part of it for sure. But it's one of those things that I believe, and I've seen this over and over in the industry as well, that the more that you're willing, like if you're willing to give without expecting anything in return, it has a way of coming back to you multiple times fold, right? So that's the way that I view it, and that's the way that Hunter views it. That's the way that we approach the industry. And it kind of seems like that's the way many others do as well, which is what makes this industry awesome.
Yeah, and it's very clear that you and Hunter are doing that extremely well in this market. I mean, not only through what you're doing with ASYM Capital, but through Raise Masters and Raise Fest and all of the events and entities you've built up around those. You're helping a lot of people in the industry.
Appreciate that.
And ultimately, I mean, this is what capitalism is about. I don't know if you know this about me, but I'm a big fan of capitalism. I don't know if I've ever said that to you before, Tyler. Maybe, I don't know.
I'm also a big fan of capitalism.
There we go.
We're birds of the same feather here.
There we go. So capitalism, when practiced well, means we cooperate and everybody wins when we do that. And you described how when we're practicing this, we're giving people a great place to live in our industry. We also need to buy software to run our systems really well. We need to buy vehicles to get between our all of these things happen, so everybody wins when we do this. And
Absolutely.
I love that you mentioned Zach Haptonstall, because he is a great example of someone who does give to other people in the community. When you described that there was someone who opened up his Rolodex, I knew that you were talking about Zach. I could tell. I knew that. But there are other people who do that. The people over at Vertical Street Ventures, you think of Stephen Louis and Jenny Gu and Kyle Mitchell and Kiyoshi Simon over
Love those
there.
guys.
They are doing wonderful stuff there. And there's so much cooperation in this industry. So it's wonderful how that all comes together.
Absolutely.
Tyler, we are coming towards the end of our time together, man. This is going quickly.
This has been fun.
This has been a lot of fun. It's going very quickly. It is. I have a long list of other questions that I want to ask you about, so we'll have to have you back and all of that. Because when I ask you a question, you are able to dig in at many levels, and that's good. And I'm not saying that you talk too much. No, not at all. I'm saying that you are very. How would I say, very giving in your answers and all of that. And that's very good for our audience across the board.
Sure.
So I'm going to ask you to give again right now. What are you reading right now, or what are you listening to right now to keep that saw between your ears, to keep that brain sharp? How do you become the Tyler Lyons 2.0? If you're 1.0, no, how do you advance your version number on yourself? How do you keep improving?
Yeah, a lot of the books that I've read recently have been on mindset.
Yes.
One of the ones that I've recommended a few different times recently is Feel the Fear and Face It Anyway. Oh man, that's such a good book. That's such a good book. Because especially in the world of entrepreneurship too, we're always doing stuff that makes us scared.
Yes. Right.
And if you're willing to let that fear slow you down,
Right.
you're not going to reach your full potential.
Sure.
You're going to be handicapped. So all the entrepreneurs out there, you've got to get comfortable with that fear. It might be
Right.
different for everybody. It might be maybe you're scared of meeting with people one-on-one to talk about. Maybe you're scared of asking people for money to invest in your deal. Maybe you're scared of public speaking. Maybe you're scared
Right.
of getting on a podcast like this and really
Yes.
putting yourself out there.
Sure.
I think that is a must read for all entrepreneurs out there.
Yes.
It's just an amazing book. So that's one that I read recently, and I'm probably going to read again this year. That's the type
Absolutely.
of book I might read every year.
Sure.
That would be my main recommendation right now from a book standpoint. And then from a podcast standpoint, I'm somewhat of a podcast junkie, so I
Okay.
listen to a lot of real estate related podcasts,
Sure.
macroeconomics related podcasts, that kind of stuff. I like to know what's going on in the industry. So the books, it's been a bit more mindset, and then the podcast has been a bit more like tactical industry sort of knowledge, I would say.
Yeah. Okay. We'll make sure we include that in the show notes. And the fact that you say this is a book that you want to read every year says a lot. So it sounds like you're getting something out of it every time you read it, those are the best kinds of books.
That's the great thing about books too, is that you might read a book one year and you're at a certain place in your life and you might take certain takeaways from it. If you come back to that same book a year or two later, you're going to be at a different place in your life and you're going to read that book through different eyes and you're going to
Sure.
take different takeaways from it. So yeah, books like that, Feel the Fear and Face It Anyway.
Yes.
It is that type of book where it should be on pretty much, anybody. I said entrepreneurs, but really anybody who's aiming high, whether you're a business owner or not.
Sure.
It's a really good book for you.
Excellent. Thanks for that recommendation. And then finally, how can people get in touch with you?
The best way to get in touch with me would be to give me a follow on LinkedIn. So if you look up Tyler Lyons on LinkedIn,
Yes.
it should be pretty ezy to find
Yeah.
there. I think there are a couple other Tyler Lyonses floating around out there.
But you
I'm-
look like you on LinkedIn.
Correct. Correct.
There you go. There you go.
And you can always reach out to us if you want to. If you have any interest in ASYM Capital, if you're interested in investing in multifamily in Phoenix, you can always send us an email as well to investors@ASYM Capital as well.
Solid.
We've got a team that monitors that inbox, and we'll get back to you within 24 hours.
Tyler Lyons, it has been a pleasure having you here on the ROIClear podcast. Great having you here, man.
Appreciate it, Ray. This has been a blast, and looking forward to doing the second part of it sometime soon.
Boom, let's do it. And thank you for engaging the ROIClear podcast. At ROIClear, we buy multifamily apartment properties, we improve them, and we give people a great place to live. At the same time, we give investors an opportunity to enjoy capital preservation, tax advantages, and a solid return on investment. If you'd like to know more, click the link to ROIClear.com down below. We look forward to speaking with you.